Welcome back to Trading Club 7U, the ultimate crash course for trading beginners. Today, we're going to cover a crucial concept that'll remove one of the biggest sources of pain for new traders: stop losses, invalidation, and protecting capital. I'd like you to imagine you're at a horse racing track, and you've placed a bet on a specific horse. If your horse wins, you'll win a certain amount of money. But if it loses, you'll lose your bet, and potentially more depending on the odds. This is similar to what happens when we trade with leverage, where our potential gains are amplified, but so are the potential losses. In trading, a stop loss is a predetermined price at which an open trade will be automatically closed, limiting our potential losses if the market moves against us. Think of it as putting a bet on a horse that you've set a maximum amount you're willing to lose. If the market hits your stop loss price, the trade will close, preventing you from losing any more money. For example, let's say you buy a stock at 100, and you set a stop loss at 90. If the stock price falls to 90, your trade will be closed, limiting your losses to 10 per share 190. However, if you don't set a stop loss, your losses could be much greater if the stock price continues to fall. Now, one common mistake beginners make is not setting a stop loss, or setting it too close to the entry price, resulting in massive losses. Another mistake is not using a trailing stop loss, which would close the trade as the stock price moves in your favor. This way, you lock in profits and protect your winning trades. A second key concept is invalidation, which is when our initial trade plan, or hypothesis, proves to be incorrect. Let's say we bought the same stock at 100, expecting it to rise to 120. If it instead falls to 80, our initial plan has failed, and we need to reassess and either close the trade or adjust our strategy. Invalidation can also occur when our stop loss is triggered, which means we need to revisit our trading plan and determine why it failed. To further illustrate the importance of stop losses, let's consider an example where you buy a stock at 50 with a stop loss order set at 40. You anticipate that the stock will rise to 60 and then continue upwards. As the stock initially rises to 60, your trade is in your favor, and you're making a profit. However, instead of pulling out some profits, you get overconfident and hold on to the trade. Then, the market suddenly turns against you, and the stock price drops to 30. In this scenario, your losses would be substantial, potentially exceeding 30, as you would have to close the trade at the lower price. This is why using a stop loss and trailing stop loss is crucial in managing risk and locking in profits. Let's practice this scenario with a practical exercise. Create a scenario in which you buy a stock at 50 with a stop loss order set at 40. Imagine the stock rises to 60, then drops to 30. Here's how you could respond. Step 1. Recognize that your initial plan has failed. You anticipated the stock to rise to 60 and then continue upwards, but instead, it dropped to 30. Step 2. Evaluate why your initial plan failed. Was it due to market sentiment, news, or fundamental analysis? Step 3. Assess the damage. You initially set a stop loss at 40, but the stock price dropped to 30, resulting in losses of 20. Step 4. Adjust your trading plan. Consider whether you should close the trade at the current price of 30 or wait for the stock to potentially rebound. In closing, stop losses, invalidation, and protecting capital are critical concepts for any trader. Remember, trading with leverage means you're taking on amplified risk. Always use stop losses, and keep an eye on them, and make adjustments to your plan as needed. Protecting your capital is key to long-term success. For a homework assignment, I want you to simulate this scenario again. This time, try setting a trailing stop loss at 45, which means that as the stock rises to 55, your stop loss price will be adjusted to 50. Then, if the stock price drops to 45, your trade will be closed. Analyze how this would have changed your outcome in the previous scenario, and discuss what you would do differently next time. Thanks for joining me on this lesson. If you found this explanation helpful, be sure to hit the like button, and subscribe to Trading Club 7U for our next lesson.